Former Federal Reserve Chair Alan Greenspan issuing a strong warning that the party's over on Wall Street. Joining us now is former presidential candidate Ron Paul, who's been warning also about a crash. Dr. Paul, great to see you again. You look terrific.
Thank you.
I know that you agree with Greenspan's conclusion, but I suspect you think it's for different reasons. Why do you think the market's about to crash?
Well, because it's expanded too much because of the Federal Reserve printing too much money. But I agree with him. You know, we better get ready to run. Yeah, I ran a little bit of track in school, and I suggest everybody get their starting blocks on their starting blocks because it could come. And, you know, the Austrian School of Economics teaches you can spot bubbles and you know where they come from through excessive credit. But what you can't tell is when it's going to come, and it takes a special event. And I got to thinking, well, I don't know when that event will be, but the way I was watching the business news today, there's been a lot of talk about tomorrow. I sure hope it isn't tomorrow that everybody has to be at their starting block. But that's one thing we don't know. And I think there's a lot more people worried about that than just myself.
You know, Dr. Paul, I think it's ironic, don't you, that Alan Greenspan should be talking about financial bubbles when he was responsible for one of the biggest financial bubbles in modern history with the you know, very close to zero interest rate policies. What would you say to him about what happened in 2008 and 2009 with the real estate bubble?
Well, I'd ask him a direct question, but I wouldn't get a direct answer. You know, we, of course, had a lot of discussions on that, and he did do exactly as you said. Because I remember when Bernanke came in, Greenspan had been there 19 years, and Bernanke came in, and they were concerned. And the one thing they said, they were hinting up to the 07-08 crash, and he kept saying, everybody was saying and agreeing, the interest rates have been kept too low too long. That was the saying. But then, of course, the policy wasn't changed, so they showed they could even do better. They went to the QEs, and that really wasn't exactly the right correction for an interest rate of, you know, low rate too long and too low too long.
Dr. Paul, I was wondering in terms of particular valuation, if you're looking at the market overall or even looking at individual industries, it doesn't seem like any of the valuations of companies are particularly frothy or bubbly. So where do you see that valuation concern that would foot with a big market crash from here?
Well, that's the whole thing. Maybe that's today. What about tomorrow? If you'd have asked me, and I don't pay close attention to particular stocks, but if you'd have asked me a few weeks ago about Apple, I would say, sounds to me like a pretty good company. So things come up, and all of a sudden they had too many cell phones, and people say, hey, how are we going to sell them? So there are so many distortions throughout. It isn't like everybody's in a everybody has separate bubbles. Everything is in a bubble because of the interest rates being low. The most important information any investor can have, or anybody who's saving money or in business, is the price of money. When you don't have a supply and demand, like in socialized medicine, all of a sudden you have shortages, or drugs. You can't judge and you can't make these decisions, and that is what happens when you have this rigged interest rates, and it breeds into it the distortion. Too much debt. Just say, look, well, there's too much debt. What is the prices of bonds? The prices of bonds are rather frothy, and I think the price of stocks very frothy. And obviously, somebody thinks they are, or they wouldn't be selling them. And why are they concerned? Depending on what the Fed does tomorrow, they might make $1 trillion decision tomorrow. That's how amazing I think it is.
Dr. Paul, it's Christina. I'm just confused, though. So then are you encouraging the Fed to go ahead, and you do think that they should not be any type of dovish pause in 2019? Do you think they should really go ahead with those 4 hikes, one tomorrow? Because, like you said, for so long you've seen interest rates just ridiculously low?
There's no way to know a correct answer for a system that has been grossly distorted. People ask me that all the time. Well, would you make the interest rate? Well, I have no idea what the interest rates are to be, except they ought to be at the market. No man on earth and no Federal Reserve Board can possibly even get an inkling of what interest rates should be. This has to be decided by millions and millions of people and trillions of dollars, supply and demand. It's an unknown. And this idea that we go through these gyrations, there for, we frequently look at the Fed's minutes and their declaration. Sometimes they'll look for one word. Oh, they changed that word from one word.
Yeah.
Wow, okay, this is changing history. Well, you know, there was a time when we didn't even have a Federal Reserve Board. There was a time when we had a Federal Reserve that didn't manipulate every minutia. They're into economic planning, and that is, and they are controlled. There is no doubt. Their main motivation is to prop up the stock market, and they did that with the bond markets too. But the prices are too high now, and the bond prices, of course, are too high. And there has to be a correction. You just can't go on forever, you know, distorting the market and running up debt. We have government inflation. Someday we'll have to correct that.
And Dr. Paul, it's Jonathan Hoenig. Thank you for being with us. I mean, I happen to think you're seeing it already in some of the bank loan and leveraged loan markets. These have been cracking it just terribly. These have been a lot of the malinvestment that has happened during the Federal Reserve. But let me ask you, sir, if we get a correction, if we get a crash, what is to stop the market, or from the people, I should say, from blaming bankers, blaming the markets, saying that we need more regulation? Seems like every time we have some type of a crash, whether it be Sarbanes-Oxley or any of the others, we get more regulation to financial markets, when my guess is you'd probably say we need less. How can we make sure that the people understand that it's the regulation of the Fed that's actually causing the problem?
Yeah, and I think that's the crucial question, and that's why I like to think that I should be in the education business, trying to teach people why this happened. Because if you look at the Depression and the 1920s, they did make the decision. They looked at it and said it was the gold standard and too much freedom, too much free market capitalism. And what did we do? We ushered in the age of FDR and on and on. So that is the big question. Will they do that? Who is to get the blame? Now, Trump is already starting. Well, the blame has to be on the Fed because they're manipulating interest rates. But this downturn isn't going to be Trump's fault, because it's been the inflation prior to this that is the problem. So if you don't look at the Fed, you can't solve the problem. Yeah. And more people are looking at the Fed now than they used to, and that makes me feel better because they're looking at the right place.
Dr. Paul, until there is a Paul University, we're going to continue to invite you to come on and enlighten all of us and our viewers as well. We love to have you. Please don't be a stranger. Thank you very much.